Hello students, good afternoon students. Welcome to this online mentoring session on Ind AS, carve-outs and significant differences between AS and Ind AS.
Today's mentoring session is on Indian Accounting Standard. This topic is newly added and is applicable to you from May 2016 examination also. This will be your first attempt for this. This will be the first attempt for this topic. This is a new topic added in the syllabus and is applicable to you from May 16 examination. This topic, before starting with the topic, let us take up the certain queries which has been put up by the students at the time of registering for this mentoring session. The first query was taken by Veer Bhathiran. He has asked which of the Ind AS, and IFRS has to study for May 16 examination. Please clarify me what are the main differences between Ind AS and IFRS. See student, from past 2-3 months, I'm coming up. Before starting with the mentoring session, let us first please note following disclaimer statements. Students are advised to refer to e-lectures available on the students' LMS for this and other topics. These lectures are freely accessible. For this, you have to register with your students' registration number and start learning immediately. Students are advised to refer to the study material, including supplementary study material, if any, and other relevant legislation for latest provisions, amendments required for forthcoming examination. As I already told you, this is a new topic added from May 2016 examination. This topic covers introduction of Ind AS, significant differences vis-a-vis existing counting standards, and carve-outs from IFRS. Now, first of all, let me explain you what is introduction of Ind AS. From past few months, we are getting queries from students which Ind AS are applicable and which Ind AS are not applicable. Whether they have to study Ind AS along with existing accounting standards, or they have to study only Ind AS or both. So, before starting, as I already told, one of the query by Veer Bhathiran was that which Ind AS is applicable for May 16 examination. So students, I would like to tell you this introduction of Ind AS includes introduction of all Ind AS. So introduction includes roadmap and summaries of all Ind AS. So first part of your query, I hope it is replied that which Ind AS are applicable for May 16 examination. All Ind AS are applicable, but however, you are not required to go in depth of all the provisions of all Indian accounting standards. You have to study the summaries of all Ind AS. The summaries of all Ind AS is also necessary to be at least to be studied, because without studying the summaries or without understanding the Ind AS, you would not be able to appreciate the significant differences vis-a-vis existing accounting standards. So it is very necessary you all at least go for one time. Please study the summaries of all Ind AS. Second part of the query was whether they have to study existing accounting standards or not. So let me tell you, this is one of the topic Indian Accounting Standard, introduction of Indian Accounting Standard, significant differences and carve-outs. This is one of the topic which is added in your syllabus. Your syllabus, existing syllabus, which was there applicable to you for November 15 examination or earlier, that syllabus is still applicable to you. Only one minor change has been made in the syllabus. That is, instead of overview of IFRS, you have to study introduction of Ind AS. So all other topics like accounting standards, corporate restructuring, consolidated financial statements, and other topics has to be studied on the basis of existing accounting standards only, except topic of accounting and reporting of financial instruments, for which we'll explain you later. However, now the second part is that which AS is to be studied, all accounting standards has to be studied, because we are seeing that this topic has been added in the syllabus in place of overview of IFRS. So it implies that IFRS are no more applicable to you, are no more part of your syllabus. So the chapter which was there in your January 2015 edition of the study material, that is in module 2, chapter 2, overview of IFRS. That is not applicable to you. You have to skip that chapter from that module, and in place of that chapter, you have to study this topic, introduction of Ind AS. For this topic, we have already come out with a supplementary study material, and the study material is there in the Swiss counter and also uploaded on the website, institute's website. You can refer from there. This material is only a this supplementary study material is only a chapter 2 of the whole syllabus, of the whole study material, not the full study material. Next part of the query was, please clarify what are the main differences between Ind AS and IFRS. Students, we are going to conduct the mentoring sessions. At least 6 to 7 mentoring sessions will be there on this topic. Today we are going to cover the carve-outs in Ind AS from IFRS and the roadmaps. However, in later part of the mentoring sessions, not today, but in later, in February, March and April, we'll be covering significant differences vis-a-vis existing accounting standards in Ind AS. So, what are the differences? You can study that from the supplementary study material, and besides that, you can also attend our mentoring sessions in that regard. One of the query, as I already told you, this is applicable for May 16 examination, and supplementary study material has already been issued for this topic. Before going to the another slide, let me cover up one more query. One student, Mr. Rohit Garg, has asked practical applicability of Ind AS is whether the practical questions will be asked on Ind AS in May 2016 examination. So student, let me tell you, the supplementary study material contains introduction or summary of all Indian accounting standards and differences and carve-outs, and not illustrations, because by giving introduction or summary of Indian accounting standards, we cannot ask you to go through the practical illustrations, to solve the practical illustrations on particular standard. So it is requested to concentrate mainly on, or focus your study mainly on differences and carve-outs, which is there in the supplementary material. But you should also go through the introduction of all Indian accounting standard at least once. You can expect theoretical illustrations, theoretical case studies or questions on this topic. So what are we going to cover in this session? Let us understand what are Ind AS, compliance of Ind AS in phase manner, exceptions, calculations of net worth, important points to remember during compliance of Ind AS, and carve-outs in Ind AS from IFRS. These are the topics which we are going to cover in our mentoring session today. Now, first of all, let us understand what is Ind AS. Ind AS are IFRS converged standards. IFRS equivalent standards are known as Indian accounting standards. These standards, IFRS standards, we have to comply with we have undergone a treaty, we have underwent a treaty with for IASB, Indian Accounting Standard Board, where we have agreed to adopt Indian accounting standard. However, later on, instead of adoption, we went for convergence, and in that process of convergence, we have made certain differences, certain as less as possible. Certain differences are there in the whatever is given in the IFRS. So we have termed those standards as Indian accounting standards. These are IFRS equivalent standards, IFRS converged standards. As IFRS are principle-based set of standards, similarly, Indian accounting standards are principle-based set of standards because they are more or less IFRS only, with certain carve-outs which we'll be covering in the later part of the session. So Indian accounting standards or Ind AS are also principle-based set of standards. These standards were earlier placed on the website in 2011 on the MCA Ministry of Corporate Affairs website. Now, in 2015, these Indian accounting standard has been notified under the Companies Act 2013. These accounting standards has been revised and then notified under the Companies Accounting Standard 2013. Sorry, Companies Act 2013 as Indian Accounting Standards Rules 2015. They are let me tell you, earlier also under Companies Act, there were set of accounting standards which were notified, and those accounting standards are Companies Accounting Standards Rules 2006. And these are Companies Indian Accounting Standard Rules 2015. So there are two different set of standards. One are existing accounting standards and one are Indian accounting standards. These existing accounting standards has been notified in 2006, and Indian accounting standards has been notified in 2015. Both are covered as rules, Companies Rules 2006 and 2015. Now, before starting, what is the relationship of Ind AS to IFRS? Let us move to the online queries in case some students have placed their queries. Okay, there is one query, Bhavleen Kaur. What will be the weightage of carve-outs and carve-ins in Ind AS vis-a-vis IFRS? So students, let me tell you, Institute does not have a policy to allocate any weightage to any particular topic. So based on past questions, based on past examination questions, we tend to understand what is the weightage of particular topic. However, there is no fixed weightage, and that particular marks on which, suppose for consolidation, it comes for 16 marks. It's not necessary. More question weightage can be increased or less also, but that is based on the past examination questions. Institute does not have a policy to fix any weightage or to give any criteria that in particular examination for how many marks questions will be asked. So for this time also, we won't be able to comment what is the weightage of this particular topic. However, it is for sure accounting standards, existing accounting standards, they are to be studied by you thoroughly, and the weightage of those accounting standards will definitely be more than Indian accounting standards. I can only tell you, please focus mainly on differences, roadmaps, and carve-outs of given in this supplementary study material, and don't expect theoretical questions. Okay, so let's move on to our PPT again. What are relationship of Ind AS to IFRS? There exist major differences between Indian economy and the world economy, and due to which all Ind AS cannot be synchronized with IFRS. See, we agreed to adopt all IFRS, but because due to change in Indian economy or certain economic conditions which differ from one country to other, it is not possible to adopt IFRS as it is. These IFRS has been first viewed from the Indian scenario, Indian economic scenario, and where it is found that that provision which is given in IFRS is not accordance to the Indian economic scenario, they have been modified. So there are certain carve-outs because of this change in Indian economy scenarios. Therefore, we have opted for convergence rather than for adoption. Because of convergence and because of certain change in Indian scenarios, economy, Ind AS has certain carve-outs from IFRS. Now, compliance with Ind AS. When to apply Ind AS, when to follow Ind AS, when to prepare financial statements based on Ind AS. Let us see. Ministry of Corporate Affairs, when notified Indian Accounting Standard Rules 2015, they have clearly mentioned in that rules that companies are free to adopt or follow Indian accounting standards while preparing their financial statements. So when companies are not bound or mandated to follow Indian accounting standard, but they can opt voluntarily. So there are two options to follow to prepare financial statements based on Ind AS. One is voluntary and one is mandatory. In voluntary, from 1st April 2015, since Indian Accounting Standard Rules 2015 has been notified in February 2015. After that, the financial years which starts from 1st April 2015, companies were free to opt to prepare their financial statements based on Indian Accounting Standard. Since there was no force, then therefore, those companies which are going to opt that, or the companies which have already opted to prepare their financial statements based on Indian accounting standard, that will be termed as voluntary adoption or follow of implementation of Indian accounting standard. However, from 1st April 2016, by rules, certain companies have to necessarily prepare their financial statements based on Indian accounting standards, which we will be explaining you which are the companies with those which are covered in this mandatory compliance. Will be explaining you later on. Indian accounting standards. First, let us know something about Indian accounting standards. These Indian accounting standards has been notified in February 2015 as Companies Indian Accounting Standard Rules 15. In that rules, 39 Indian accounting standards has been notified. Out of this, there were 15 15 Ind AS 101 to 115, and remaining were, that is 24 Indian accounting standards starting from Ind AS 1 to Ind AS 41. Numbering of Indian accounting standards has been given based on the numbering which is there in IFRS. IAS 1 is given as Ind AS 1. IFRS 1 has been given as Ind AS 101. This is the difference. IFRS are the standards which has been released, which has been promulgated by Indian Accounting Standards Boards, while Indian Accounting Standard or IAS are the standards which has been issued by Indian Accounting Standard Committee. So International Accounting Standards IAS are numbering are same, but they are started from in Indian Accounting Standard. They are started from IAS 1 is Ind AS 1, IAS 2 is Ind AS 2. However, IFRS, the new terminology which was used by International Accounting Standard Board, is also now when those standards were adopted or converged in as Indian accounting standards, the numbering were taken in series of 100. So it is now Indian Accounting Standard 101 for vis-a-vis IFRS 1, Indian Accounting Standard 102 vis-a-vis IFRS 2, and so on. These Ind AS are applicable voluntarily from 1st April 2015 and mandatory from 1st April 2016 and 1st April 2017 for certain class of companies. If a company opts for voluntary compliance of Indian Accounting Standard from 1st April 2015, then that company has to prepare their financial statements for the period ending on 31st March 2016 based on Indian Accounting Standards. So the reporting period will be 31st, reporting date will be, in fact, please read this period as date. Their reporting date will be 31st March 2016 and their reporting period will be 2015-16. And once you have opted for preparing your financial statements based on Indian Accounting Standard, then you have to also prepare comparatives for the periods ending on 31st March 2015. So a company whose reporting date is 31st March 2016, they have to prepare comparatives for 31st March 2015, immediately preceding financial year. This is the reporting date. This is the comparative date for preparing comparative financial statements. If you are preparing a financial statement based on Indian Accounting Standard, whether it's a standalone financial statement or consolidated financial statement, Indian Accounting Standard will be applied to both. If you are preparing your consolidated financial statement based on Indian Accounting Standard, then it is necessary that your standalone financial statement should also be prepared based on Indian Accounting Standard. You cannot do that. You prepare your standalone financial statement based on existing accounting standard and you have consolidated financial statements based on Indian Accounting Standard. Both the financial statements, whether standalone or consolidated financial statement, they both has to be based on same standard, either existing accounting standard or Indian Accounting Standard. Since we are talking about voluntary compliance of Indian accounting standards. So if your financial statement, anyone, either standalone, if your standalone financial statement is based on Indian accounting standard, then your consolidated financial statements should also be based on Indian accounting standard, or vice versa. And once you are applying your once you are applying Indian accounting standard for preparation of your financial statement, that Indian accounting standard is to be followed consistently. You cannot do that you follow 5 Indian accounting standards and leave out 34 Indian accounting standards. Wherever applicable, you have to apply all Indian accounting standards if you are applying at least any one Indian accounting standard. So all Indian accounting standard has to be applied consistently, and this consistency is to be there year after year. It is not that for 31st March 2016, for your reporting date is 31st March 2016, or for period 2015-16, you prepared your financial statements based on Indian accounting standard, and next year you shifted to existing accounting standards. No, it is not possible. You have to prepare your financial statements in coming years also based on Indian accounting standard. If you have voluntarily opted for preparation of financial statements based on Indian accounting standard in the current reporting period. So if you are preparing your financial statements based on Indian accounting standard for the period ending on 31st March 2016, so your financial statements for 31st March 2017, for 31st March 2018, all will be based on Indian accounting standard only. This is an irrevocable option, and you cannot look back for existing accounting standards.
Basically, the consistency term is very important. You have to, once you start applying the Ind AS, you cannot revoke it back, and you cannot say that now the criteria of application is not being fulfilled in this particular year because of my financial data. I will not apply, and now I will continue to, I will have the option to apply existing accounting standards. No, I cannot. Once I have started using Ind AS, I will have to use it forever. This is the main principle of consistency which is to be applied. No need to prepare another set of financial statements. If you are preparing your financial statements as per Ind AS, you are not required to prepare any other set of financial statements, and apply to all subsequent financial statements. As we have already explained, that in all the coming financial years, all the financial statements will be prepared as per Ind AS only.
Let us try to understand this with the help of an example. Suppose A Limited opted to prepare its financial statements for the period ended on 31st March 2016 as per Ind AS. See, for 31st March 2016, there was only voluntary compliance. There was no mandatory compliance. Mandatory compliance starts with 1st April 2016. So if a company opts for preparation of financial statements based on Indian accounting standard from 31st March 2016 and has prepared their financial statements on 31st March 2016 based on Indian accounting standard, and then based on that financial statement, when they calculated their net worth, that net worth was less than 500 crores, which is one of the mandatory criteria for application of financial Indian accounting standard
Applicability to
for 1st April 2016. This is the mandatory one of the mandatory criteria for preparation of financial statement based on Indian accounting standard from 1st April 2016. That is, your net worth should be more than 500 crores.
So the term net worth is very important, which is explained in the companies itself, and we will explain in the later slides how you will compute the net worth. This is very important. And if the company earlier was covered by this net worth of 500 crores, and now on a later year, in a later period, it is not covered, its net worth is less than 500 crores, then it cannot say, it does not have that option to prepare its financial statement as per the existing accounting standards. It has to prepare its its financial statements as per Ind AS, even if its net worth is less than rupees 500 crores in this particular year, if it has started preparing financial statements as per Ind AS in the year ended on 31st March 2016.
So we can say, if a company voluntarily opted for
Preparation
for Ind AS, though its net worth was less than 500 crores, his net worth was less than 500 crores, but in 2015-16 they opted for Ind AS base financial statement. But when they prepared their financial statement based on Ind AS, they faced certain difficulty. Definitely, this is the first time adoption of Indian accounting standard. They would have faced certain difficulty, and because of that difficulty, they want to go back, and they have seen that on 31st March 2016, the net worth is less than 500 crores, so they do not fall under the mandatory compliance of rupees 500 crores on 31st March 2017, and they want to prepare their financial statements based on existing accounting standards. From 2016-17. So can company do this? No. If they have opted for preparing financial statement based on 15-16, then they do not have any option. This is an irrevocable option. They do not have the option to come back to existing accounting standard. They have to continue preparing their financial statement based on Ind AS for 2016 as well, and in fact onwards also.
So basically, it's very important for a company to decide whether to apply Ind AS if its threshold limit of net worth is not covered under the
for first
application
time
criteria. For first time compliance, it's very important to make a decision whether to apply Ind AS or not if we are not covered by that threshold criteria of 500
that
crores.
Voluntary compliance should also be opted judicially, because once you have opted it, whether voluntarily or mandatory, you cannot go back. So you have to be very judicious for voluntary compliance. And once you have applied your financial statements based on Ind AS, it becomes your threshold criteria or criteria for mandatory compliance becomes immaterial. So that is to be taken care of.
If our threshold limit of net worth is more than 500 crores, then definitely we do not have any option. We have to apply Ind AS only. So the calculation of net worth is very important here to understand the criteria.
So what we have already explained you, whether it's mandatory or voluntary, once you have applied your financial statements based on Indian accounting standard, you have to continue your further subsequent years financial statements also based on Indian accounting standards.
Mandatory compliance, as we have already discussed, that from 1st April 2016, few companies which are listed and having net worth of rupees 500 crore or more, they are mandatorily required to prepare their financial statements for the year ending on 31st March 2017. So basically, for the first time under mandatory compliance, the financial statements for the year ended on 31st March 2017 will be prepared as per Ind AS for the certain class of companies. For two, basically I am dividing these companies under two categories: listed companies if they are having net worth of more than 500 crores, and unlisted companies if they are having net worth of more than 500 crores. From 1st April 2016, they have to start apply Ind AS, and the first year financial statements will be made on 31st March 2017. So all the listed companies as well as unlisted companies are required to prepare their financial statements for the year ended on 31st March 2017. The applicability date is from 1st April 2016, but the financial statements will be prepared for the year ended 31st March 17. This is the reporting date, and with the comparative for the period ending on 31st March 2016. So 1 year, previous year, immediately preceding year, all the comparatives will be given for that particular year. All the listed companies having net worth of listed as well as unlisted companies having net worth of rupees 500 crore or more. So this criteria amount is very important. We have to remember this while applying the application compliance part to the given practical scenario. All the holding, subsidiary, joint ventures or associate companies of all such companies, whether listed or unlisted, if they are having net worth of more than 500 crores, they will be mandatorily required to comply Ind AS from 1st April 2016. They are not having any option. Mandatory compliance means the companies are not having any option, but they are required to apply these Ind AS. This was in the earlier slide. This was the first phase which was covered. From 1st April 2016, as we have already explained, for certain class of companies, Ind AS are applicable from 1st April 2017, with the comparatives for the period ending on 31st March 2017. Which are these companies? Unlisted companies or listed companies having net worth of less than rupees 500 crores. So if the listed companies are having net worth of less than rupees 500 crores, they are not required to prepare their financial statements from 1st April 2016, but they are having that option that they can have 1 year exemption, and they are required to comply from 1st April 2017 rather than 1st April 2016 if their net worth is less than rupees 500 crore and they are listed companies. However, for unlisted companies, this criteria of net worth is not 500 crore, that is 250 crore. So for unlisted companies, if they are having net worth of rupees 250 crores or more, but less than rupees 500 crores, they are required to prepare financial statements for the year ended 31st March 2018 for the first time. So basically, the difference is for listed companies, even if they are having the net worth of rupees 100 crore or maybe whatever amount of net worth they are having, but if it is less than 500 crore, but they are listed companies, even if they are having net worth of 0, they are required to mandatorily comply the Ind AS. But for unlisted companies having net worth of rupees 250 crore or more, so the limit is equal to 250 crore or more, but less than 500 crore. If it is more than 500 crore, then they will be required to comply from 1st April 2016, not 1st April 2017. So this is the difference. They are giving the relaxation of 1 year for application of Ind AS.
Suppose on 1st April to 31st March 2017, your net worth was 500 crores, but earlier your net worth was not 500 crores. Still, you cannot say that now this year the criteria is 250 to 500. From 500 crore and above, you are mandated to apply Ind AS for your financial statements from 1st April 2016. If after 1st April 2016, suppose on 1st April 2017, your net worth has reached to 500 crores, then also it will be said as that you are mandated to comply your Indian accounting standard for preparation of financial statements. So the coverage of application of Indian accounting standard has been increased from first year to second year. So it is not that those criteria which was there in that first year will not be applicable in the second year. That besides that criteria, in addition to those criteria which was there in 1st April 2016 to comply for Indian accounting standard, in addition to those criteria, further criteria has been increased, or the scope has increased for application of Indian accounting standard. Not only listed unlisted companies, those whose net worth are more than 500 crores are covered for Indian accounting standard based financial statements, but all types of listed companies whose financial net worth are 500 crores or less than 500 crores or more than 500 crores, they are forced to prepare their financial statements based on Indian accounting standard from 1st April 2017. So from 1st April 2017, any listed company is not exempted to prepare their financial statements based on existing accounting standard. They have to prepare their financial statements based on Indian accounting standard, all listed companies. However, for unlisted companies, still certain exemption is there. For unlisted companies having net worth of less than 250 crores, they are still exempted to prepare their financial statements based on Indian accounting standard. But those unlisted companies who's having net worth of 250 crores or more, whether 500 crores, whether 500 crores plus, they have to prepare their financial statements based on Indian accounting standard?
Basically, from year to year, we are trying to enhance the applicability part, and we are trying to see that more and more entities are covered by the mandatory compliance of Ind AS. The main aim is to apply the Ind AS to more and more companies, to more and more number of companies in a phased manner. From 1st April 2016, we are restricting the scope to few companies only. And from the later period, from 1st April 2017, we are trying to enhance the scope so that more companies can be covered by reducing the amount of threshold limit. So that is the main criteria. Holding, subsidiary and joint venture of associate companies of all such listed and unlisted companies are also covered, as we have already told that all the companies which are covered under mandatory compliance of Ind AS, all those companies holding, subsidiaries and joint ventures, associate companies of all such companies will automatically be covered under the mandatory compliance of Ind AS.
Now, before moving further, we would like to see if there is any online query. We'd like to answer that. Okay. Due to following of Ind AS in 2016-17, if the profits of the company for previous year 2015-16 comparative year are changed, how will those be dealt with? Will company have to take any additional? See, students, while preparing financial statements, it is very necessary that if you are following financial statements mandatorily from 1st April 2006 for the year 2016-17, it means if you are preparing your financial statements for the period ending on 31st March 2017 based on Indian accounting standard, then you have to prepare comparative financial statement. You have to present comparative financial statement figures based on Indian accounting standard for immediately preceding year. So that comparative figure should also be based on Indian accounting standards. So for the year 2015-16, yes, you have to recalculate your all the assets, liabilities. You have to calculate all your assets and liabilities, and based on Indian accounting standard only, you have to prepare the comparative figures. You have to provide the comparative figures. So in that process, it is possible that profits changes and you have to mention that. But however, that will only be a comparative figure.
Mr. Manohar, you have asked that all there chances of any practical problem being asked in the examination from the topic of Ind AS. In this regard, we would like to say that being a student, you are required to have an idea, to have an overview, awareness of the Ind AS and the significant differences of Ind AS vis-a-vis existing accounting standards plus carve-outs from IFRS. So basically, generally the theoretical type of question should be asked in the examination, and you are advised to have an idea. No practical problem would be asked based on the provisions of Ind AS. So you are not required to have detailed awareness, detailed knowledge of the Ind AS. You just are advised to read the summaries and to have the overview idea, to have an awareness of all the Ind AS.
Because of until unless you don't have the idea or the general knowledge about that particular standard, you will not be able to appreciate the differences, significant differences vis-a-vis existing accounting standard. To understand those differences, it is very necessary. You should know the summary. You should understand the Indian accounting standard. At least an overview, you should have an idea of the overview of Indian accounting standard. One of the query by Mr. Agrawal. Even if subsidiary, joint venture, associate company, being a foreign company, is also required to comply with? Yes. See, consolidated financial statements consolidate the financial statements of holding companies, subsidiaries, joint ventures, and associates. So that consolidated financial statement has to be prepared based on Indian accounting standard. However, if subsidiary, associate, or joint venture company is a foreign company, then they are free to prepare their financial statements based on local gaps as well. However, since they are functioning or doing their business in India, they have to prepare the financial statements based on Indian accounting standards also. If mandatory compliance and if voluntary compliance, parent has opted for voluntary compliance.
Saurav Wagle. Saurav Agle is asking that if the unlisted company is having net worth of 600 crore as on 31st March 2014 and it does not opt for voluntary adoption of Ind AS for financial year 2014-15. As on 31st March 2016, the said unlisted company is having net worth of 250 crore. Is it compulsory to adopt Ind AS? The criteria will be the threshold limit will be decided or based on the particular date. As on 1st April 2016, if it's more than 250 crores, then it's an unlisted company.
So let me tell you, for this I would like to explain. See, mandatory compliance starts with 1st April 2016. So for compliance, for this mandatory compliance of Indian accounting standard from 1st April 2016, we have to look into the net worth as on 31st March, immediately one day before that compliance, or at the last reporting date, 31st March 2016, you have to check the net worth. As in the example, you have taken the example of 2014-15 and 15-16. So let me tell you, if on 31st March 2016, the net worth of unlisted company is 250 crores, then they do not follow under that criteria of 500 crores and above. For 1st April 2016, for mandatory compliance of Indian accounting standard, it is very necessary, whether it's a listed company or unlisted company, net worth should be 500 crores or above. In the given example or the example which you have taken the net worth of unlisted company as 250 crores, which is very less than half of 500 crores. So they are not mandatorily applicable. They are not forced to prepare their financial statements based on Indian accounting standard. However, they have the option for voluntary appliance of Indian accounting standard.
If this date you have asked is in spite of 31st March 2016, if it would have been 31st March 2017, then the listed company, even if its net worth is rupees 250 crore, it would be required to apply Ind AS on 31st March 2017. Now let us move to the PPT itself. So all the provisions of mandatory compliance of Ind AS have already been explained. There are few exceptions. Companies which are not required to apply Ind AS. Insurance companies, banking companies, non-banking finance companies, and all the companies which are listed on SME exchange, they are not required to apply Ind AS. Certain exemptions have been granted under the roadmap, wherein these companies are given the exception criteria. They are not required to apply Ind AS right now. They will be forced to apply Ind AS in the later phases and maybe in the later years under the different roadmap. Under the current roadmap, these companies are right now exempt.
As a press release, a roadmap has been issued by, it's a press release, so not notification, not a notification, so it's not bounded by any company. It's a press release. For banking companies and insurance companies, they have come out with a roadmap. So it's simply a press release. It's not a notification. I'm repeating it again. It's not a notification. Still is under consideration. However, a certain proposed roadmap has been issued by MCA for banking and insurance companies via press release. But this is only for your knowledge purpose.
But right now they are not required.
This is not applicable to you. Information of that you can study as an additional knowledge, as a general knowledge to you. I'm just sharing this with you. It is not applicable for May 16 examination. As of now, for May 16 examination, as per roadmap which is notified by the MCA,
all these companies
are not forced to prepare their financial statements based on Indian accounting standards.
So the very important computation of net worth, which is a main criteria for deciding whether the company is required to follow Ind AS, whether the company is required to prepare its financial statements as per Ind AS, or it is exempted, or it has the option to apply existing accounting standards for preparation of financial statements. So this criteria is very important to be understood. Clause 57 of Section 2 of the Companies Act 2013 defines net worth. So what is net worth? Net worth is paid up share capital. As we can easily appreciate what is paid up share capital. All reserves created out of the profits. So It means these reserves should be created out of profits. They should be available reserves. They should be freely available reserves. Securities premium account minus, first of all, you have to add paid up share capital to all reserves and securities premium, and you have to deduct accumulated losses, all the previous accumulated losses. If you are having deferred expenditures, any miscellaneous expenditure, if you have not written off to your P&L account and it is still existing in the balance sheet, these are basically fictitious accounts which do not increase the net worth of a company, but they are just being shown on the credit side or debit side of the balance sheet. So basically these are not representing any of the assets, these are not representing any of the worth to the company. So all these accumulated losses and deferred expenses and miscellaneous expenditures are deducted from the amount of paid up share capital and all reserves created. So this is basically the calculation of net worth. You have to calculate the net worth from the given financial statement of a company, and then you have to decide whether you are required to prepare the financial statements as per Ind AS or not. Now, what reserve do not include and what reserves include? Reserves does not include reserves created out of revaluation of assets. Any of the assets, if you have revaluated and you have created the difference to revaluation reserve, that reserve is not part of the net worth. Write back of depreciation, any provision for depreciation, and any amalgamation reserves, if you have created, those reserves will not be covered under the calculation of net worth. How you will calculate? Either on the basis of standalone financial statements or on the basis of consolidated. So it's very clearly mentioned that the net worth is to be calculated on the basis of standalone financial statements only, or the first audited financial statements of an entity. Net worth calculated for the first time at the end of the accounting year and apply Ind AS from the immediate next accounting year. It means if you are you have to apply the Ind AS for the accounting period 16-17, then you have to see the net worth on 31st March 2016 and not on 31st March 2017. If you are preparing the financial statements for the year ended 31st March 2017, then for the applicability part, the net worth will be calculated as if it is to be seen on the date of 31st March 2016. Net worth is to be calculated on 31st March 2016. So that's what it's clearly given here. Net worth calculated for the first time at the end of an accounting year and apply Ind AS from the immediately next accounting year. From the next accounting year, for the applicability of Ind AS for the coming year, you have to see the net worth at the end of this particular year. We can take one small example. All the companies meeting threshold limit for the first time as on 31st March 2017 shall apply Ind AS for the financial year 2017-18 onwards. So the threshold limit of net worth is to be seen as on 31st March 2017 for application for the period 2017-18. So for calculation of net worth, we have to see the date of 31st March, or the paid up share capital, the reserves, securities premium. That account will be seen as if it exists on the date of 31st March 2017, and for the for preparation of financial statements of 17-18 onwards. The companies meeting threshold for the first time as on 31st March 2018 shall apply Ind AS for the financial year 18-19 onwards, and so on. The same. It is in the same manner. So what are the points to remember? When Indian company is a holding company, that is parent company, all the overseas subsidiaries, associates, joint venture, and other similar entities may prepare its standalone financial statements as per their local gaps. If Indian company, if in India, the parent company is located, its all overseas subsidiaries, associates, joint ventures, and all other similar entities in foreign countries may prepare their financial statements as per their local gaps, not as per Ind AS or not as per
they can prepare their standalone statements as per Indian accounting standard as well as per their local GAAP. However, if an Indian company is an Indian company is also business functioning in India only, then they need not prepare two sets of financial statements. However, overseas companies may prepare two sets of financial statements, one based on Indian accounting standards and one based on their local GAAP.
And Indian company, parent company, if Indian company is a parent company, then definitely Indian company will prepare its financial statements in accordance with Ind AS, either voluntarily or mandatorily, as the case may be. If it's not required to apply, it may have the option of applying existing accounting standards, or if it's mandatorily required to prepare its financial statement as per Ind AS, then whatever the case may be, it has to.
But in both the cases, they have to prepare a financial statement based on only one set of standard. If they are preparing it based on existing standard, they can continue with existing standard only. It's not necessary that one standalone statement is based on existing accounting standard and consolidated financial statement is based on Indian accounting standard. Both the statement has to be prepared based on one set of standard.
Basically, for the comparison portion also, we generally it is advised to prepare two sets. It's not advised that you prepare one set as per the different set of accounting standards and consolidated you prepare according to different set of accounting standards. So whatever way you are preparing, you have to prepare standalone as well as consolidated on the same basis. When Indian company is a subsidiary, associate, joint venture, and other similar entity of a foreign company. So it's a reverse case, as we have covered in the earlier slide. We had the Indian company as a parent company, and the subsidiaries, associate, joint ventures were located in the foreign countries. Now, in here the case is reversed. We have the Indian company is subsidiary, associate of a foreign company. Now, what Indian company will do? Indian company shall prepare its financial statements as per Ind AS, either voluntarily or mandatorily, as the case may be. So, points to remember. This is a crux you have to remember for the applicability part. Ind AS shall apply to both standalone financial statements and consolidated statements. If Ind AS are applied, then it will apply to both standalone and consolidated financial statements. If existing accounting standards are being applied, then also it will be applied to both. Ind AS shall be applied consistently. We cannot do that in one particular year. We are applying Ind AS. In the next year, we want to take the exemption option and we want to apply the existing accounting standards. We cannot do. If we are started using Ind AS, we have to apply. We are required to apply it consistently over coming years. Option to adopt Ind AS is irrevocable. So that is what we have already told, that if you have started using it, you cannot take the option that from this particular date, my criteria is not being fulfilled. I am taking the exemption benefit and now I am not going to apply Ind AS. I will apply existing accounting standard. That option is not revocable. You cannot go back. No need to prepare another set of financial statements as per existing accounting standards. If you have if you have prepared financial statements as per Ind AS, you are not required to prepare another set of financial statements as per existing accounting standards. And it will be applied to all subsequent financial statements irrespective of non-application of the criteria threshold limit, as we have already told, that once you have started using it, once you have started applying it, you cannot go back, you cannot start applying another set of existing accounting standards. Once you have started preparing your financial statement as per Ind AS, you have to apply it consistently.
Significant differences in Ind AS vis-a-vis IFRS. So before starting with this particular part of the mentoring session, we would like to move towards the online queries in case students have placed some online queries. This we have covered. For unlisted, Mr. Manohar Parwar has asked, for unlisted company as on 31st March 2017, net worth is equal to 250 crore or more. Then 250 crore for mandate of Ind AS? Yes. If your net worth on 31st March 2017 it is for unlisted companies is 250 crores or more, in that case, yes, they have to mandatory prepare their financial statements based on Indian accounting standards from 1st April 2017. Criteria for unlisted companies for mandatory application of Indian accounting standards from 1st April 2017 is net worth above 250 crores. So, as given in your example, unlisted company is having a net worth of 250 crores. So, yes, they are mandated to follow Indian accounting standard while preparing their financial statements. What about non-corporate entities? For entities other than companies from which financial year Ind AS would be applicable? See, students, as of now, Indian accounting standards has been notified by Ministry of Corporate Affairs. Ministry of Corporate Affairs deals with companies. So, as of now, Indian accounting standards are only applicable to companies or corporate entities. For non-corporate entities, you have to follow Indian accounting standards. With time, the coverage of Indian accounting standard will increase, their scope will vast, but as of now, for non-corporate entities, you have to follow existing accounting standards and not Indian accounting standards. Indian accounting standards are the standards which are notified by the Ministry of Corporate Affairs. However, if you go through the website of the institute, this is again for your knowledge purpose. Our Indian accounting standards are also in the process of revision and are also in the process of to come in the line with Indian accounting standards. So for non-corporate entities also in later years, in future period, it will be that we'll have an accounting standard which is in line with Indian accounting standard, or which will be in harmony with Indian accounting standard. But as of now, those revised standards which are based on Indian accounting standards are in the form of exposure draft and are not applicable to you. For non-corporate entities, that is, you have to follow existing accounting standards only. And for corporate entities also, for certain companies only, Indian accounting standards will be applicable mandatorily. And for other companies, they have to follow existing accounting standards only.
Bhavleen Kaur is asking that if unlisted company is having net worth of INR 250 crores as on 31st March 2017, then definitely if the unlisted company is having the net worth of rupees 250 crore, then if it is equal to 250 crore or more than it will be required to follow. It will be required to apply Ind AS for its preparation of its financial statements. Now we can
move on again to our PPT
for understanding the significant differences.
Significant differences in Indian accounting standards vis-a-vis IFRS. Before starting with the significant differences, let me explain you. There are certain terminology which has been used differently in IFRS and which are used differently in Indian accounting standards. Though Indian accounting standards are IFRS equivalent in standards or IFRS converse standards, still certain terminology has been, the leverage has been taken by the Ministry of Corporate Affairs to use the terminology which is more commonly used in India. These terminologies are: the term balance sheet is used instead of statement of financial position. In IFRS, wherever they have to use balance sheet, they have not used balance sheet, they have used the term statement of financial position. As we know, balance sheet depicts the financial position of particular entity at the particular date. So in India, this is the very common terminology which is used, which is balance sheet. However, in IFRS, statement of financial position is used, which is equivalent to balance sheet. So in Ind AS, we will not find statement of financial position. Everywhere, wherever it is used as balance sheet. The term balance sheet is used. Similarly, for profit and loss account, and IFRS uses the term statement of comprehensive income. Their statement of comprehensive income includes statement of profit and loss as well as statement of other comprehensive income. So instead of two different terminology, in IFRS, one terminology is used, that is statement of comprehensive income. However, in Indian scenario, the common terminology is statement of profit and loss, which is used in Schedule 6, now revised, sorry, which was used in Schedule 6 as per Companies Act 1956 and now in Companies Act 2013 also. In Schedule 3, we continue with the terminology statement of profit and loss. The same terminology is also used in Ind AS instead of statement of comprehensive income, which is used in IFRS. Though there is a difference in usage of terminology, the definition or understanding is to be same. There is no change in the definition or in the understanding of the terminology. Only the terminology wordings has been changed. Again, the words approve the financial statements for issue have been used instead of authorize the financial statements for issue. At many places in IFRS, where financial statements, issued financial statements are to be, they have used authorized. However, here we have used approved the financial statements. Now we come out with the significant differences in Ind AS vis-a-vis IFRS. Before starting with that, let us understand why are there differences in Ind AS and IFRS. What are the basic criteria for which these differences has been created or have been come into the picture. First change is on account of certain IFRS or in IFRS interpretations which has not been notified or accepted by Ministry of Corporate Affairs. And other changes, other differences are on account of a difference in application of accounting principles and practices and economic conditions prevailing in India. Since the economic conditions which are prevailing in India is different from the economic conditions which are there in the foreign countries, certain applications or certain accounting principles and practices which are prescribed in IFRS as it is, they have been modified. Because of that modification, differences has come into the picture, and that is one of the ground on which we can say the differences are based. They are carve-outs in Ind AS. Differences in application of accounting principles and practices and economic conditions prevailing in India has resulted into carve-outs or carve-ins in IFRS, carve-outs or carve-ins in Ind AS from IFRS. There are certain other major changes in Indian accounting standards vis-a-vis IFRS. However, those certain other major changes which are not due to application of accounting principles and practices will not be termed as carve-outs. This last part, this is other major changes which is not termed as, which will not be termed as carve out. We have not discussed this in this mentoring session. We'll cover this topic also. However, in the later part of mentoring session, it will not be possible to complete the full mentoring session with all the topics. So in this mentoring session, we are restricting to this part, that is differences in application of accounting principles and practices and economic conditions prevailing in India. Other major changes which are not resulting into carve-outs will be dealt in the coming sessions, which will be taken in the month of February or March. First criteria which we have seen is that certain IFRS or IFRS has not been notified by Ministry of Corporate Affairs. These are IAS 26, International Accounting Standard 26, which is on accounting and reporting by retirement benefit plans. This standard has not been notified as Indian accounting standard. The reason for its non-notification is that this standard is not applicable to companies. And since I have already told you, Ministry of Corporate Affairs deals with the dealings of companies. So for companies, since the standard is not applicable, the standard has not been notified. So this is one of the reason for the changes, that this standard has been not has completely not taken into account. Similarly, there is one interpretation which is International Financial Reporting Standard Interpretations 2, that which is on members' shares in cooperative entities and similar instruments, which has not been issued by our Ministry of Corporate Affairs, or which has not been considered. This is also because this particular IFRIC is not applicable to, is not relevant to the company. So this has also been not taken into notification, and this also resulted into one of the change in or significant differences vis-a-vis IFRS. Now, certain carve-outs which are on account of change in accounting policies, practices and economic conditions prevailing in India. One first carve-out is in Ind AS 1, that is presentation of financial statements. Ind AS 1 is equivalent to IAS 1, International Accounting Standard 1, which is on presentation of financial statement. Based on that international accounting standard, we have come up with Indian accounting standard, that is Ind AS 1, presentation of financial statements. But one major change has been made, or one carve-out has been drawn in that Ind AS 1, that is based on loan liability. Indian accounting standard states that in case of a loan liability, basically here the loan liability, we mean a long-term loan liability. That is, we can say, which is classified as non-current in our balance sheet. In International Accounting Standard, that is in IAS, it is said, in case of loan liability, if any condition of loan agreement which was classified as non-current is breached on the reporting date, or certain conditions are not met out with by the customer on the reporting date, such loan liability should be classified as current. So earlier that loan was a non-current liability, but because of certain conditions, breach of certain conditions or conditions not met out, such loan has been reclassified as current. Reclassified as current liability. This is the provision stated in IAS 1. Where the breach is rectified after the balance sheet date, IAS requires loan to be still classified as current. So even though that breach or the condition which was not met out on the reporting date is met out or is rectified by the customer after the balance sheet date, before approval of the financial statements by the shareholders, before approval, or where we say before authorization, as we have shown in a terminology difference, they have used before authorization of financial statements by the shareholders, still that loan will be classified as current instead of non-current. However, a carve-out has been made in Ind AS 1. What happens? In Ind AS 1, it is said, if on reporting date certain conditions were not met out or breached by the customer, but before approval of financial statement and after reporting date, that breach has been rectified or condition has been met out, then that particular loan will not be reclassified from non-current to current. It will be classified as non-current only. Ind AS 1 clarifies that where there is a breach of a material provision of long-term loan arrangement. Please note the following important words. These are material provision of a long-term loan arrangement on or before the end of the reporting date. If on the reporting date you come to know that certain material provisions has not been met out by the customer, or certain material provisions has been breached by the customer, and because of that breach of certain provisions, that liability becomes payable on demand. It means the company or the entity which is lending that loan gets the right to immediately call off that loan and to get the payment on behalf of that loan, it means that liability becomes payable on demand on that reporting date. Then that loan shall be classified as current if conditions are not met out before approval of the deal. If breach is continued even till before approval of the financial statement. However, if that breach is rectified or the conditions are met out, then in that case, that loan will not be classified as current. It means it will be classified as non-current only. So in IAS 1, whether you rectify the breach or you don't rectify the breach, it will be classified as current. There is no option, there is no way out, or there is no gray way. However, in Ind AS, we have given this way out if that condition is or that breach is rectified before approval of the deals. For example, you are preparing your financial statement for the period ending on 31st March 2017. For example, this is just an example. On this date, you have a non-current liability, non-long-term liability on which certain conditions has been breached. Later on, this financial statement is approved on 31st August 2017. 31st August 2017. So between March, from 1st April 2017 to 31st August 2017, that is April, May, June, July, August, that is within 5 months. If a customer rectified that breach and before approval of financial statement, that is before 31st August 2017, then that loan will not be reclassified from non-current to current. That loan will be still continue in your balance sheet as on 31st March 2017 as non-current liability. It will not be reclassified from non-current to current. Hope it's clear. Now, what is the reason for this carve out? Why we have drawn this carve out? Why we have not accepted the provision which was given in the IAS 1? See, in Indian scenario, basically this carve out is given or drawn keeping banking system in our mind. In banking system, being a chartered accountant or being in under articleship, you will definitely go for a bank audit by your principal. You will be sent to bank audit by your principal. In there, you will find in banking system, many conditions are not met out, but later on the customer rectifies it once bank informs them, see, this is the condition, these are the papers which you have not submitted, these are the material provisions, or these are the material papers or compliance which you have to do it, but you have not done it. But later on they say, okay, customer says, okay, I'll comply with it, and maybe with a late of 2 or 3 days or with a late of 2 months, they fulfill those criteria, they rectify the breach, they submit the papers, because of which there is no further breach which is continued. In that case, reclassifying that particular loan from non-current to current will disturb the balance sheet. Most of the things, because in Indian scenario, mostly the mindset of customers is that a customer relationship with the bank develops in such a manner that even bank is also lenient. Okay, if you're not giving the paper today, please submit it by tomorrow, or please submit it by next month. That relationship is developed between bank and the customer. Because of that, customer also takes the advantage to submit the paper by some delay. Because of that delay, if we follow the International Accounting Standard or IAS as it is, all of our liability will be converted into a current liability, will be reclassified as current liability. So in our balance sheet, your current ratio is going to be disturbed. Your current liability will be much more than your current asset because of such non-compliance, especially in the balance sheet of banking companies. So keeping that into mind and keeping the mindset of the Indian people, it has been decided that generally people do not having the intention of defaulting or breaching the contract. It is basically their delay behavior that setback or granted behavior because of which the conditions are not met out within time. But because of that, you cannot treat that loan as current liability. So carve out has been drawn, seeing the economic conditions prevailing in India. Such loans on which certain breaches which has been rectified after reporting date, that is after 31st March, but before approval of financial statements by the shareholders, that is whatever the date, 5 months, 6 months. If that breach is rectified, then that breach will not be, then that loan will not be reclassified from non-current to current. It will be classified as current, non-current only. However, in International Accounting Standard, it will be classified as current, whether it has been rectified later on. But in Indian Accounting Standard, we permit you to, if the breach has been done, then please rectify it before approval of the financial statement. Now, based on this carve out, we have to come for the second change we have to come for a change in another accounting standard also, that is Ind AS 10. Ind AS 10, that is on events after the reporting period. As per IAS 10, rectification of any breach after the end of the reporting period is a non-adjusting event. It means, as we have seen in previous carve out, in International Accounting Standard, that is IAS 1, any rectification of breach after reporting date, either before approval of the financial state, will not be taken into consideration, and that will be, again, the loan will be classified as current only. However, we give a carve out that yes, if the breach is rectified, then it will be considered as it will be classified or presented as non-current liability only. It will not be considered as current. It means what? It means that rectification is possible after balance sheet date. So this rectification after balance sheet date will be an adjusting event as per Ind AS 10. However, as per IAS 10, it will be a non-adjusting event because it will not be taken into consideration for reconsideration of classification of liability. So the carve out here is that as per IAS 10, such rectification of breach after reporting date is a non-adjusting event, and since it is a non-adjusting event, it will not be taken into consideration. However, for Ind AS, yes, it is a adjusting event because that rectification of breach after reporting period but before approval of financial statement is taken into consideration, and it is considered as an adjusting event. So this carve out is in conjunction with the carve out which is given in Ind AS 1. Let's move on in case, because these two carve outs were interrelated to each other, we have explained these two carve outs. In case there is any query, we may check it out. Otherwise, we'll move to the another carve out. So, one of the query is IFRS applicable for May 16 examination? No, students, IFRS are not applicable for May 16 examination. In place of IFRS only, we have come out with a topic, Introduction of Ind AS, which we are covering in this mentoring session. And this topic is applicable for you for May 16 examination, and IFRS you are not required to study. Overview of IFRS, which was there in your January 2015 edition of the material, that is not applicable to you. Please do not study that. Now let's move back to our PPT once again. Now another carve out. We have covered two carve outs till now. The reason for carve out we have already told you, because in Ind AS 1 we have made one carve out. Because of that we have to modify Ind AS 10 also. Now another carve out, the third carve out which is there. Basically we are having carve outs in 8 standards. This is the third carve out. This is the third standard in which there is a carve out. This is Ind AS 17. Leases. Before understanding the carve out in Ind AS 17, let us see what is said in IAS 17. What is the provision given in IAS 17? IAS 17 requires all lease rentals to be charged to statement of profit and loss on straight line basis. In case of operating leases, unless another systematic basis is more representative of the time pattern of the user's benefit, even if the payment to the lessor are not on that basis. What is there? Suppose you have a lease agreement there's a lease agreement between lessor and lessee in which the lease rentals are decided, which are say 10,000 per annum. Now that 10,000 per annum is to be, in case of operating lease, lessor charges these lease rental or recognize these lease rental in their statement of profit and loss as income. However, in IAS 17 says that yes, whatever your lease rental is, that you have to charge it in your profit and loss or recognize in your statement of profit and loss based on straight line basis in case of operating lease. Unless please, it comes the another point, unless another systematic basis is more representative of the time pattern of the user's benefit. Suppose the cash inflow which you are getting is different from the cash outflow. Even to the payments to the lessor are not on that. So again, we'll read this. Unless another systematic basis is more representative of the time pattern of the user's benefit, even if the payments to the lessor are not on that basis. So this is said from the point of view of lessee. If lessee is getting some benefits from that lease rental or inflows from that lease, which is not on straight line basis. Suppose lease has been taken for 3 years. Lease has been taken for 3 years. First year, the inflows of lessee is 8,000, 11,000, and then is 9,000. Sorry, it is 9,000, and here it is 13,000. In total, they have an inflow of 30,000. Right? The lease rental is 10,000 per year. IAS 17 says that you have to charge on straight line basis this lease rental to your statement of profit and loss in case of operating lease. It means 10,000 every year. However, this lease rental can be, instead of straight line basis, can shift to based on inflows of lessee in case your user's benefit, user means lessee, user's benefit is not different from the time pattern. It's not based on the actual pattern. Its benefit is different, is in different pattern. Then you can charge these lease rental instead of straight line basis on the basis of this pattern. That is, instead of 10,000 first year, they can charge 8,000. Instead of second year 10,000, they can charge 9,000 to profit and loss. And in third year, instead of 10,000, they can charge 13,000 to profit and loss account. This is what IAS 17 states. Besides these things, any other reason cannot be acceptable, is not acceptable for charging lease rental to statement of profit and loss as per IAS 17. Only your user's benefit, pattern of user's benefit, if it's different from the lease rental pattern, then you can charge it based on pattern of the user's benefit. In other cases, you cannot do that. However, there is a carve out in Ind AS. In Ind AS, they have said if because of inflation, the lease rental increases. As an Indian scenario, inflation is a very common feature. Every year, the inflation is there and is increasing year by year. So a carve-out has been made to provide that lease rentals in case of operating leases shall be charged to statement of profit and loss in accordance with the lease agreement. We do not say if there is a difference in the inflow of the users benefit is in different pattern, then we have to do it on the different pattern. No, we say please do it as per the lease agreement. If your lease agreement says 10,000 per year, please charge it in your profit and loss based on that lease agreement, 10,000 per year. Unless the payments to the lessor are structured to increase in line with expected general inflation. So as per Ind AS, you have to charge in your profit and loss lease rental based on your lease agreement. Not necessarily it is straight line matter. First year, if your lease agreement is of 10,000, next year it is 12,000, next and third year it is 15,000, then you have to do it 10,000, 12,000, 15,000 respectively. However, as per IAS 16, you do it on straight line basis, then you have to add all the 3 lease rentals, divide by 3, and then you have to charge it on straight line basis. However, in Ind AS, we have given this liberty that as per lease agreement, whatever your per year lease is, you charge it to accordingly. But in case of inflation, if your lease rentals increase next year, then that increase in lease rental will also be taken into account while charging it to profit and loss account. If payments of the lessor vary because of factors, however, if the payment of lessor vary because of factors other than general inflation, then this condition is not met out, but then means that variation will not be taken into consideration. If inflation is the reason for variation of lease rental, then that will be taken into consideration. If inflation is not a reason, because of any other reason there is variation in the lease rental, then we will not take that into consideration as per Ind AS. As per Ind AS, then your lease rental will be charged in your profit and loss based on the lease agreement. So you have to do it based on the lease agreement. If there is a clause of inflation, then inflation will has to be considered. This was your third carve out. We are having 8 carve outs. This was your third carve out. The reason for your third for this carve out is that, as I already told you, inflation is a common feature in Indian scenario. So this has been taken into consideration. This escalation of clause is there in the agreement only, that every year or periodically that rent will be increased based on the inflation prevailing at that time. So to compensate the lessor for that expected inflationary cost increase, the rental shall not be straight line. We cannot put it on the basis of straight line. Next carve out is in Ind AS 28, investment in associates and joint ventures. Let us first understand what is the provision given in IAS. IAS 28 requires that for the purpose of applying equity method of accounting in the preparation of investors' financial statement. Ind AS 28 or IAS 28 is investment in associates and joint venture. For associates, accounting is done as per equity method. So requires that for the purpose of applying equity method of accounting in the preparation of investors' financial statement, uniform accounting policies should be used. In other words, if the associates' accounting policies are different from those of the investor should change the financial statements of the associate by using same accounting policy. See, as you have already prepared for a consolidation file, this is the chapter in your study material also, consolidated financial statements. In consolidated financial statements, what you have to do is, you have to consolidate 2 different financial statements, one of one entity and another of another entity. So because there are 2 entities involved, the financial statements of 2 different entities are involved, then definitely there is a possibility that they have 2 different accounting policies also. Suppose in your in one financial statement, for inventory, let's take an example of inventory. They are preparing their inventories, or they are valuing their inventories based on net realizable value. However, another entity is valuing their inventory based on cost. Or you can say first entity is valuing inventory based on first in first out and FIFO method, and another entity is valuing their inventory based on weighted average method. So 2 different accounting policies are used by 2 different entities in preparing their respective financial statements. However, when we are consolidating these 2 financial statements, we need one uniform accounting policy. That is there in AS 21 also. This you have studied for your consolidated financial statement, which is there in your study material. So we need one uniform accounting policy. In general, the accounting policy which is applied by parent company or the holding company is considered and is to be followed by the subsidiary company also, or the subsidiary company's financial statements are reinstated based on the accounting policy which is adopted by parent company or the holding company. So IAS 28 says that the company has to follow the uniform accounting policies. There is no if and but. They have to reinstate their financial statements, or subsidiary company or associate company or joint venture company. Here it is associate and joint venture company. So associate company has to reinstate their financial statement based on the accounting policy followed by the parent company. A carve-out has been made in Ind AS. We are saying yes, it is necessary to reinstate the financial statements based on uniform accounting policy. To bring the financial statement under uniform accounting policy, we have to reinstate it. However, this is to be done if it is practicable. Unless impracticable to do so, it means if things are not reachable or not feasible, they are not practicable to do it, that reinstatement of financial statement is not practicable to do so. In that case, company or the associate company is given leverage that they can use their financial statement, or the time gap can be changed. This carve out is drawn in Ind AS 28, or this leverage or this relaxation is given by Indian accounting standard to their entities or corporate entities, that if it is not practicable, please do not reinstate it. It is, but if it is practicable, please and please you have to reinstate it. However, IAS 28 is not giving such relaxation or exemption. They have to, anyhow, they have to reinstate it. Now, what is the reason for such a carve out? See, certain associates are small entities which are there in the rural areas, like in banks. They have regional rural banks are generally associates or of nationalized banks. They are not in a position to use Ind AS. So if your nationalized bank is using Ind AS and you ask rural bank also to prepare financial statements based on Ind AS, they will not be able to do so. In that case, we say it is not practicable. It is impracticable to do so. So those regional rural banks have got exemption as per Ind AS not to reinstate their financial statements, or those rural banks will be given such exemption. It is just an example. Rural bank, it's for non-corporate entities, sorry, for small entities, small and medium-sized entities, or we can say small and medium corporate SMCs. This exemption is given where they are not able to apply Ind AS fully. Another carve out is in Ind AS 32. As per Ind AS 32, equity, see, as we have already taken mentoring session of financial instrument, where we have said financial instruments can be either financial asset. Financial instrument is a contract which gives rise to financial asset or financial liability or equity instrument. So for equity conversion option, for equity instrument, we have said that any liability which is denominated in foreign currency, as per IAS 32, any liability which is denominated in foreign currency will not be considered as equity instrument. That has to be considered as financial liability only. So equity conversion option in case of foreign currency denominated for convertible bonds is considered derivative liability which is embedded in the bond. So where we are saying convertible bonds, convertible means the bonds which will be later on converted into shares or stock security of the entity. Such convertible bonds are embedded derivative. In embedded derivative, there are certain components of equity instrument and there are certain components of liability instrument, financial liability. So in general, we say equity conversion option is there, or equity instrument is there only when that bond is denominated in their local, in their functional currency. If it is denominated in the foreign currency, then there is no equity conversion option, and that will be considered as, that bond will be considered as derivative liability in toto. that there will be only financial liability, there will be no equity instrument element of equity. However, and the difference between of which is embedded in the gains or losses arising on account of change in fair value of the derivative need to be recognized in the statement of profit and loss. So IAS 32 says if that bond is denominated in foreign currency, since it is a foreign currency, so exchange fluctuation will be there. So gain or loss arising on account of change in that exchange fluctuation, that is the fair value of the derivative, need to be recognized in statement of profit and loss. Now let us see what Ind AS says. A carve out has been drawn in Ind AS 32. Ind AS 32 says, and the liability, there is a definition of financial liability in Ind AS 32. Ind AS 32 deals with definition part of financial asset, financial liability, equity instrument. In the definition of financial liability, an exception has been provided in Ind AS 32, which was not there in IAS 32. As per Ind AS 32, in paragraph 11b subclause 2, which is for definition of financial liability, whereby conversion option in a convertible bond denominated in foreign currency to acquire fixed number of entities' own equity instrument is classified as an equity instrument if the exercise price is fixed in any currency. So there it was written that exercise price is to be denominated in funds for if the exercise price is denominated in foreign currency. So as per IAS 32, it will be a liability. However, which currency is there for dealing of for denomination of exercise price? This is immaterial in Ind AS 32. As per Ind AS 32, if your exercise price of foreign convertible bond is denominated in any currency, whether it's functional currency, whether it's foreign currency, it's immaterial, it will always be termed as equity instrument. There will be no liability in such case. So it's an exception to the definition of financial liability. The financial liability as per IAS 32 says if it is in foreign currency, it will be a liability. If it is not in a foreign currency, it is in a functional currency, then it will be an equity instrument. However, Ind AS 32 says any currency, foreign currency or functional currency, it will always be an equity instrument. And when it is an equity instrument, it means that the gains or loss because of liability, gain or loss was charged to statement of profit and loss. And fluctuation in foreign currency is a very common feature. However, the reason for this carve-out, the statement as per IAS 32 is not appropriate in instruments because foreign convertible bonds, foreign currency convertible bonds, since the number of shares convertible on the exercise of the option remains fixed. What happens? What is the feature of foreign convertible bonds or foreign currency convertible bonds or FCCBs is that number of shares are defined. That this number of shares is to be converted in future date. On the exercise of the option remains fixed, and the exercise of the option remains fixed, and the amount at which the option is to be exercised in terms of foreign currency is also fixed. When number of shares convertible is fixed, amount is fixed. So merely the difference of this currency, whether it's a foreign currency or functional currency, we cannot simply classify it into liability. Any currency, merely the difference in the currency should not affect the nature of derivative. It should be considered as equity instrument as per Ind AS 32. However, IAS 32 says this currency is material. If it is foreign currency, then it will be liability. If it is functional currency, then it will be equity instrument. Further, the reason is also the fair value of the option is based on the fair value of the share prices of the company. If there is decrease in the share price, the fair value of derivative liability would also decrease, because of which would result in recognition of gain in the statement of profit and loss. However, it's an option, nobody will avail the option. This would bring unintended volatility in the statement of profit and loss due to volatility in share prices, because share prices is very volatile. It shifts ups and downs and ups and downs. In that case, you have to every time charge it through statement of profit and loss. That volatility of change in share price will also make your profit statement of profit and loss volatile and will not depict a correct picture of your financial statements. This will not give a true and fair view of the liability. As in this situation, when the share prices fall, the option will not be exercised. When the share prices increase, definitely your option is to be exercised, and you have to be, if it's a call option, then you'll be gaining. If it's a put option, you'll be in loss. It has been considered that if such option is classified as equity, then that fair value fluctuation in the fair value will not be there, because equity instrument is not to be every time to be is on fair value through P&L. Then that exception will not make your statement of profit and loss volatile. Before starting with carve-outs from IFRS in Ind AS 101, let us first see we have any online query in case we have number of queries. What is the meaning of toto? As you said now in the session, toto means in total. If I don't remember where I have used this term, I guess it was used in term of liability. So financial liability in Ind AS 32, see, for derivatives, because it's an embedded derivative, there is an element of financial liability and there is an element of equity. So where the currency is, where the foreign convertible bonds are denominated in foreign currency, where FCCBs are denominated in foreign currency, there is an element of liability. So there is no element of equity. There's only one element, that is of liability. So in total, total means in total there will be only financial liability. The derivative will be treated as financial liability. However, if it is under Ind AS 2, the treatment is to be done, same foreign currency bonds is to be dealt as per Ind AS 32, then we have to see what is equity instrument, what is the element of equity in that foreign currency convertible bond, and what is an element of liability. So that carve out that there is a foreign currency or any currency is immaterial as per Ind AS. There will be two elements, equity instrument and financial liability. However, in Ind AS 32, if it is foreign currency convertible bond denominated in foreign currency, then there will be no equity instrument. It will only be financial liability. So that's what I meant by toto, that there will be only financial liability as per IAS 32. However, as per Ind AS 32, there will still be an element of equity instrument existing in that foreign FCCBs. Next question, my Mr. Agrawal, is difference between carve-in and carve-out. Okay. See, carve-outs are that the provisions which are there in IFRS. If in Ind AS we are not complying with all the provisions which are there in IFRS, and we are making certain deviations or certain modifications in the provisions while framing Indian accounting standard, then that modification will be termed as carve-out. However, if we are complying all the provisions which are given in the IFRS, but besides that, we are making certain additional guidance, we are making certain additional provisions which are not in contradictory with the provisions given in IFRS, but they are in addition to the provisions which are given in IFRS, then in that situation, it will be considered as carve-in. Accounting for financial instruments and related are not applicable for May 16. So whether Ind AS 32 will be applicable, since we don't have to study related AS 30. See student, I am here not teaching you the differences between existing accounting standards and Ind AS. Here today's mentoring session is covering the differences between Indian accounting standards and international accounting standards. It is not between Ind AS and AS. It is differences between Ind AS and IFRS. So these differences are applicable to you. IAS stands for International Accounting Standard or Indian Accounting Standard. IAS stands for International Accounting Standard. Maybe at some places by mistake, by slip of tongue, I have said it as Indian Accounting Standard. But yes, IAS stands for International Accounting Standard, and Ind AS are separately mentioned as Ind AS. Let's come back to our PPT and continue with our carve-outs. Carve-outs from IFRS in Ind AS 101, first time adoption of Indian accounting standard. In this standard, we are having 4 carve-outs. Since we are running off time, we'll be moving in speed so that we cover at least all the carve-outs. There are 4 carve-outs in this particular standard. First carve-out is definition of previous gap under Ind AS 101. In Ind AS 101, at many places the term previous gap has been used. This previous gap, what is previous gap, is defined in IFRS as the basis of accounting that a first time adopter used immediately before adopting IFRS. Since the standard itself says first time adoption of standards. So first time adoption of in IFRS 1, which is first time adoption of IFRS, there it is mentioned if an entity is adopting any financial statements and that financial statement was prepared by based on any other standard or based on any other gap or the act, that act or the standard on which that particular financial statement was based is termed as previous gap as per IFRS 1. However, a carve out has been made in Ind AS 1 because we were already having a set of accounting standard which was followed by corporate entities before application of Indian accounting standards. Companies existing accounting standard, there's a company's accounting standard rules 2006 which came into the picture in 2006, mandated all corporate entities to follow those accounting standards. So these financial statements were prepared based on those existing accounting standards. So Ind AS has said it's not any other local gap or any gap or any act, it is only those accounting standards. So as per Ind AS, previous gap means existing accounting standard, existing notified accounting standards, and not any other gap or any other act or something, because financial statements of corporate entities were to be based on existing notified accounting standards. So as per Ind AS, this existing notified accounting standard is termed as previous gap. But as per IFRS, any base on which financial statements are prepared were termed as previous gap. Second carve out in this standard Ind AS 101 is, sorry, let us understand the reason. I had already told you, since Ind AS, companies were mandatorily required to prepare their financial statement based on existing accounting standard rules 2006 before application of Ind AS. So previous gap will always be termed as existing accounting standards. Second carve outs in Ind AS 101 is allowing the use of carrying cost of property, plant and equipment on the date of transition of Ind AS 101. See, when you are preparing your financial statement for the first time based on Ind AS, IFRS 1 says that you have to either on transition date, either items of property, plant and equipment shall be determined by applying retrospective value as per Ind AS or should be recorded at fair value. So if any asset, any property, plant and equipment which was there in the financial statements of the entity and that entity is now applying Ind AS, they can take that property, plant and equipment either at fair value or we have to reconsider the value of that property, plant and equipment retrospectively based on Ind AS. However, a carve out has been made in Ind AS and they say besides that retrospective application or besides that fair value adoption, an additional option is given. That additional option is of to use the same carrying value of item of property. It means, as you know, if you are preparing your financial statement for the first time based on Ind AS 101, it means your financial statements were earlier prepared based on existing accounting standard, that is on the previous gap as per Ind AS. If your financial statements were previously prepared based on existing accounting standards, the carrying value of that property, plant and equipment will not be denied or will not be considered as inaccurate, will be considered as acceptable or will be considered as accurate, and Ind AS provides an additional option that you can use that carrying value or you can continue with that carrying value while preparing your financial statements based on Ind AS 101. This is an additional option given. We are not denying with the options which were given in IFRS. However, it will be considered as carve out because if an entity opted for using the same carrying value which was there as per existing accounting standard to continue with that carrying value, it will be in contradictory with IFRS. Therefore, this will be considered as carve out. The reason is that old companies, those who are having very old assets, retrospective application is not possible. Maybe that they have write off the value of the asset, but that asset is still there in the balance sheet. So retrospective application of Ind AS is not possible, is a very tedious, cumbersome job for those companies, and it will be not practicable also. So Ind AS 101 provides this relaxation to such companies that they can continue with the carrying amount which is there in the as per existing accounting standard. Third carve out in the same standard is long-term foreign currency monetary item. See student, as you know, as per AS 11, earlier any exchange difference was charged to profit and loss. Later on with MCA's notification, you get an option that you can charge any exchange difference in their long-term foreign currency monetary item with respect to acquisition of asset, depreciable or non-depreciable asset can be capitalized. However, this provision is not there in IFRS. So no provision is there in IFRS 1. However, a carve out has been made in Ind AS 1 that if a company has opted for capitalization of such exchange difference, then that exchange difference can be continued and they can. Ind AS 1 provides that a first-time adopter may continue the policy adopted for accounting for exchange differences arising from translation of long-term foreign currency monetary items recognized in the financial statements for the period ending immediately before the beginning of the first Ind AS financial reporting period as per the previous year. So, Ind AS 1 gives the carve out that they can continue that policy, they can capitalize the financial statements, so they can capitalize the exchange differences on account of such foreign currency monetary translation they can capitalize that instead of charging to statement of profit and loss. Accordingly, same Ind AS 21, which is on foreign currency exchange difference, there also a modification has been made, and there also we have said in transition period, entity can continue with the accounting policy which was earlier adopted by long-term foreign currency monetary items for capitalization. The reason is that I already told you because AS 11, the para has been added by MCA where the option has been given to capitalize it. So that option is continued in Ind AS also. Fourth carve out is financial asset or intangible assets accounted for in accordance with Appendix C. Service concession arrangements to Ind AS 115, revenue from contracts with customers. See, in service concession arrangements for toll roads, where there in case of toll roads. First time adopter may apply the transitional provisions in IFRS 12. IFRS 12 is for service concession arrangements for toll roads, in case of toll roads. A carve out has been given in Ind AS 101. Basically, what is the carve out? In IFRS 12, it is mentioned that they have to apply this transition as retrospectively. However, in Ind AS 101, we have given that except for this particular case, except for the policy adopted for amortization of intangible assets arising from service concession arrangement related to toll roads. For other amortization of intangible assets, we have to do it retrospectively, but for service concession arrangements related to toll roads, we can do it prospectively. Other conditions are same. They have to recognize financial assets and tangible assets, use the previous carrying amount and check it for impairment. The reason for this carve out is that Schedule 2 also says that revenue based amortization is done. However, Ind AS 32 was saying revenue based amortization is done only in circumstances in which the predominant limiting factor of an intangible asset is the achievement of revenue threshold. then only revenue-based amortization is done. However, as per Schedule 2, revenue-based amortization is done. So what we have done is that in order to provide relief to such entities, Ind AS 38 and Ind AS 101 have been amended to allow the entities to continue to use the accounting policy adopted for amortization of intangible assets arising from service concession arrangements related to toll roads recognized in the financial statements for the period ending immediately before the beginning of the first Ind AS financial statements. They can continue based on the value taken, and prospectively they can amortize it. IFRS, this is also one of the major carve out in the Ind AS 103 business combination. IFRS 3 requires bargain purchase gain arising on business combination to be recognized in profit or loss. What is bargain purchase gain? Difference between net assets and the purchase consideration. If your net asset is more and your purchase consideration is less, then you are getting assets of more value and you are paying less for it. So you are gaining in this process. That gain is considered as bargain purchase gain, and that gain is recognized in profit and loss as per IFRS 3. This is when your net asset is more than purchase consideration. In our Indian scenario, we say it as a capital reserve. There in IFRS 3, it is termed as bargain purchase gain. Carve out is that if we say this bargain purchase gain will not be recognized in profit and loss. This has to be recognized in other comprehensive income and accumulated in equity as capital reserve. It has to be accumulated in equity as capital reserve, but not directly recognized in equity. It will be directly recognized in equity when this bargain purchase gain is clearly evident that yes, this is a bargain purchase gain. It shall be recognized. At that time, it will be recognized directly in capital equity as capital reserve. Reason is that in Indian scenario, we acquire a business and we consider it as a capital acquisition. So any gain because of that capital acquisition will also be considered as capital gain, shall be recognized in equity or in other comprehensive income and shall not be considered as revenue gain. Therefore, should not be charged to profit and loss. If we charge such gains into profit and loss, it means any unrealized gain will also be charged to profit and loss, because net assets at the time of valuation, at the time of business combination, is calculated by considering the fair value of all assets less fair value of liabilities is equal to net asset. Now this fair value means the value which is other than the value which is recognized in a balance sheet. It means unrealized gain on this asset and unrealized gain, maybe gain or loss in this liability, will be recognized to profit and loss if this bargain purchase gain is charged to P&L. So to avoid such situation, to avoid that recognition of unrealized gain to profit and loss, we will consider such bargain purchase gain to be treated or to be recognized in other comprehensive income only. Because if it is recognized in statement of profit and loss, then it may be distributed in the form of dividend also. However, this is an unrealized gain. Dividend should be only from realized gain, from the free reserve or from the realized gain, not from unrealized gain. So it will be inappropriate and will be violation of the provisions given in the Act. So such unrealized gains are transferred to other comprehensive income and not charged to profit and loss. Moreover, such a treatment may lead to structuring through acquisition. Through acquisition, you may structure your profit and loss to avoid such conditions or to avoid that that structuring to be done by the company or to mislead the stakeholders. This acquisition, this bargain purchase gain is also said to be recognized in other comprehensive income. One are carve out from IFRS and Ind AS 115, revenue from contract with customers. In case there is any penalty included in your contract or is levied in the performance of the contract. Say, suppose you are able to perform the contract. If your performance of the contract is not up to the satisfactory level, certain penalties are levied. That penalties as per IFRS 15 will be considered as variable in nature and has to be recognized in revenue. However, as a carve-out, Ind AS 115 states that penalty shall be accounted as per the substance of the contract. Whether penalty is inherent in determination of transaction price, it will be a variable. It will be variable in nature. However, if that penalty is other than what is the transaction price, then that will not be considered, and transaction price will be considered as fixed and not affected by the penalty clause. Besides carve-outs, there is one carve-in also. Let me tell you, I have already explained, carve-outs means any deviation from the provisions which are given in the IFRS is carve-out. But any guidance which is besides what is given in IFRS and is not in contradictory with the provisions given in IFRS will be considered as carve-in. And one carve-in has been drawn in Ind AS 103, that is business combination. IFRS 3 excludes from a scope of business combination of entities under common control. They have not explained what is business combinations of entities under common control. However, in Ind AS 103, we have given an extra guidance in this regard, that what are business combinations of entities under common control. So this extra guidance will be treated as carve-in because this is not violating the existing provisions of IFRS 3. It is in addition to that. So this is a carve-in. Certain other differences are also there in Ind AS from IFRS, but these will not result into carve-out. These are particular these standards. And because of paucity of time, I am not covering such differences. We'll cover it in some other mentoring session, which we will be conducting later on. These are the other standards where there are carve-outs. Sorry, there are differences which do not result into carve-out. So what we have studied till now is that voluntary compliance of Ind AS is from 1st April 2015. Mandatory compliance of Ind AS is from 1st April 2016 for all companies, whether listed or unlisted, whose net worth is more than 500 crores. However, from 1st April 2017, for all listed companies, whether their net worth is 500 crores or less, they have to follow their financial statements based on Ind AS. They have to follow Ind AS for their preparation of financial statement. However, for unlisted companies, net worth 250 crores and above, they have to prepare their financial statement based on Ind AS. Once the threshold criteria is met, we are not required to check it year after year, because once you are preparing your financial statements based on Ind AS, your financial statements in future years will also be based on Ind AS. Once you are preparing your financial statement based on Ind AS, you are not required to prepare another set of financial statement based on existing accounting standard. Thank you. In case of any query, I have missed out in this one slide. In case of any further query on this session, on the topics which we have taken, you may please mail me at shilpa@icai.in. Also call me at 012030459116. Before ending the session, let me see in case we have any online queries. Well, if the session can be viewed offline, no, this session are not recorded, so they cannot be viewed offline. These are live sessions. Okay, one student has missed out the differences between carve-in and carve-out. Akshay Goel is asking this question again. Carve-outs are the differences in the provision where Ind AS are in deviation with the provisions which are there in IFRS. They are in contradictory with, they are not following the provisions of IFRS as it is, then that will be termed as carve-out. However, carve-in is something whatever we are following IFRS as it is. Besides that, certain additional guidance or additional provisions are given which are not in contradictory with the existing provisions given in IFRS. Then that are Carve. This I have explained you just now also. There is only one Carve, that is on business combination. For business entities under common control, one extra guidance has been given in Ind AS 103. This is Carve. Besides that, all the differences which we have discussed right now are carve outs. Another query by Mr. Akshay Goyal is, ma'am, on which page of supplementary study material this carve out has been given? See, in supplementary study material, we have covered the carve outs and carve-ins standard wise. So at the end, whatever the standards which we have mentioned, like in Ind AS 1, Ind AS 10, Ind AS 32, 28, 17, 101, 103, they are carve outs. So you will be finding these carve outs in their respective standards. Please go through the index portion or the content sheet of the supplementary study material. They will find out the heading before at the end of every standard. We are dealing with 3 points: major differences vis-a-vis existing accounting standards, vis-a-vis Indian IFRS, which results in carve-outs, which do not result in carve-out, and third, major differences vis-a-vis existing accounting standards. Anand Khambe has asked page 1202. Sorry, I cannot understand what is your query. Please be specific, and in case you have any technical query, I will prefer, please mail me over my mail ID shilpa@ici.in. I'll be replying you there. You can also call me for general queries at 0120-3045-916. For technical queries, I would like you to mail me over the email. Thank you. One more question. In a nutshell, the exemption limit for unlisted company is 0 to 250 or for the period ending. In fact, net worth cannot be 0 crores. It was wrongly written there. It's in fact any net worth which is less than 250 crores for unlisted companies, then they will not be allowed to, they are not mandated to prepare financial statements from 1st April 2017 also. For 1st April 2018, no criteria has been mentioned. So as of now, we can say unlisted companies having net worth less than 250 crores are exempted to prepare their financial statements mandatorily as per Ind AS. They are free to opt for financial statement based on Ind AS, or they can continue with their existing accounting standard based financial statements. See, Gaurav Bohra has asked to provide guidance for another supplementary chapter 6. Let me tell you, I have already covered 2 mentoring sessions. In fact, my previous mentoring session, which was on 13 January, it was for at least for about 2 hours, and that was on financial instrument. Before that, that same financial instrument, first part of that topic was covered on 8 January. We have covered only the definition part on the 8 January mentoring session. So we continued with the topic financial instrument on 13 January, where we have dealt with the measurement and recognition part. Unfortunately, these are only live sessions. They are not recorded, and they cannot be seen offline. So you have to go through the study material, revised chapter, and in case you find any query or face any difficulty, you can mail me. Is any mentoring session gonna be held for that? As of now, no, we are not going to continue. We are not going to conduct any mentoring session on financial instrument because this Ind AS topic is vast. We are not able to complete the carve-outs, or we are not able to complete the significant differences between IFRS and Ind AS. It's only the carve-outs which we have covered. Differences which do not result into carve-out, we were not able to cover, though we have exceeded 2 hours. The session is of 1 hour. So it will not be possible to repeat that topic, because for Ind AS only we are going to take at least 6 to 7 mentoring sessions. That will be later on for differences between existing accounting standards. My question was Carve of Ind AS 103. Okay. 103 Carve is that an extra guidance has been provided by Ind AS in 103, that is business entities under common control. This business entities under common control, this definition or this criteria for provision how to deal with business combinations under such situations has not been dealt by IFRS, but has been dealt by Ind AS 103. So this is an extra guidance. That's why it's in a Carve. In a nutshell, the exemption limit for unlisted companies is for a period. I've already told you, yes, for exemption limit for unlisted. Exemption limit, yes, you can say it's an exemption limit if your net worth, if the unlisted company's net worth is less than 250 crores, yes, they are exempted to prepare their financial statements based on this. Thank you, students. Hope you have try to get the maximum benefit from this mentoring session. In case any queries, you have any technical query, I'm again telling you, please mail me over my mail ID, that is shilpa@ici.in. In case of general queries, you can also call me at 012030459116. This is the 916 is the extension number, and the whole 0120 is the STD code. 3045916. This is the direct landline number. You can call me over it. Thank you, hope, and all the best for your exams.